Hey everybody, this is Ryan Madrid with VIP Mortgage. Tom came up with my new slogan. It's called Getting Real with Ryan. That's only going to be today. So my guest here is Tom Ward with Majestic Consulting. And the reason why I brought Tom on is I had a meeting with him recently, and he was basically finally explained to me how a P&L actually works. And I think most LOs that don't run their own branch or trying to run their own team now don't know how the money's really handled and how everything works. So when I finally sat down with Tom, it was like so eye-opening. I was like, you know what, we're going to sit down and we're going to talk to basically every LO out there that wants to watch this, and we're going to send it out and finally try to understand how exactly you're getting paid and how it comes down from the warehouse lines down to the corporate, to the branch, to the LO. Because it's shocking, and I think a lot of people do not know. So just give me a little bit of background behind you.
Yeah, it's just I came right out of high school. I went into the Air Force and figured out it wasn't going to be for me, right? So I decided that I learned the electronics industry there and kind of went out and did my thing there for about 6 months to 8 months and wound up selling real estate part-time. For a Century 21 broker, and then fell in love with it and basically moved up the ladder of, buying my own franchise, and then I bought two others and ultimately started Majestic Mortgage back in '87 to feed my real estate company at that point in time. But interesting enough that I didn't really know the numbers as much as it is, so I came from the approach that I learned the numbers a different way, which I call business blood pressure, right? It's smaller numbers. And then be able to take it from there. And I sold Majestic in May of '06, right before the crash.
Smart.
Right? Yeah, no, wasn't that smart. But, May of '06 I sold it. And then for the last, 12 and a half years, I've been consulting and training and speaking to the mortgage business, primarily on profitability, right? It just comes down to, it's a loosely used term. I think that if you're talking to the loan officers who are watching today, it's really important to know your numbers. Whether you're running a P&L or not, you've got to know those numbers, and I think that's really where it comes down to.
Right, and right now there seems to be a lot of movement. There has been probably for like the last year. A lot of people are looking different places, whether it be a brokerage. I know people are going over to, well, for example, this weekend we had a big event for this charity group I'm in, EC70. We had this thing called The Taste, and I was there with my friends that own a brokerage. I was there with a friend that is now over at like a private client bank who left, a big correspondent. And then obviously we had a bunch of guys from VIP there, and people were talking, and everybody seems to think that their scenario is the best scenario ever, right? And I think that there is opportunities, right, to make money in every angle. But it all comes, the money is coming from somewhere, right?
Yeah.
And not everybody understands, why or how they're getting paid. So it's hard. I mean, it's just, it comes back to, I guess, you had that article in LinkedIn
right.
that kind of just talked a little bit about, that scenario, right?
Yeah, LO comp.
Right? LO comp.
You look at it two perspectives, right? The company looks at it, and the post says LO comp, too high or too low.
Right.
You're looking at two different perspectives, right? I mean, the first perspective is from a company standpoint and thinking LO comp is too high, right? Because they're thinking that's the profit leak, that they have. From an LO's perspective, they're looking at it saying, I think I should get paid more. Yeah. Right. And ultimately, where does it all come from? Right. So for the last 6 months, I put together a study, branches at the branch level. And I basically went down the line, 491 months. And I wanted to get to the bottom of it, to be able to just say, tell me, is LO comp really the problem, that we're paying loan officers too much money?
Right.
491 months, Ryan, individual branch months, all sizes, shapes, and colors. Right, small broker doing $2 million to a mega mortgage banker doing $60 million a month, right?
Yeah.
And all over the country, Florida to Maine to Chicago to California to here, and ultimately, 94% of the time, it had nothing to do with LO comp. The profitability of a branch had nothing to do with LO comp, 94% of the time. So there's a telling, and it's a great sampling, 491 months, right?
Yep.
So what I did find after those 491 months is the cause of profitability leak in most mortgage companies and branches, whichever way you want to look at it, is bloated costs, right? I mean, they've just got too much overhead, and ultimately, that's what's killing them, right? That's the bottom number of business blood pressure, right? Is what it costs you to get a loan out the back door. I would often challenge companies all day long to be able to say, tell me what it costs you to get a loan out the back door.
Right.
And they look at me like a deer in headlights. It's like, whoa, I don't know. And you see all kinds of surveys out there. And I think, to me, the easiest way to understand this is in basis points, which is BP, and BP is blood pressure, right? So the two of those go hand in hand when you start to see that. But
is that when you're getting back to like understanding the rate sheet?
Yeah, right. And just how does the rate sheet get built, right?
Yeah.
I mean, as far as when you look at that, I think the one thing that's a huge takeaway for most, if you're listening, to this, and I'd write this one down, everything costs something.
Right.
The only question is who's going to pay for it, right? So you might look at this and say, well, how do we get there? How does my rate sheet get built? It's kind of a weird business because it's built backwards, right?
Well, explain that though. Like, so say somebody has, let's talk about like an FHA loan.
Yeah.
Right. How is that built into pricing? Like, how do we do that?
Yeah. I mean, well, first of all, there's really 4 components.
Okay.
Built into price, right? Where you ultimately come up with the sum of that, and that becomes what you're added on to the rate sheet. So let's just say, for an example, let's say a company of your size, right, where you're looking at that, and I'm just going to throw numbers out of easier math. Let's just say for all the services that Jay provides at VIP to his employees, to his P&L branches or whatever it is, let's just say his costs are 100 basis points, right? So you take 100 basis points. And let's just say the loan officer says, I want 150 basis points in comp. Well, 150 is 250. Let's just say your expenses at the branch level are another 100 basis points, right? So now you're at 350, right? And let's just say you wanted to have a 25 basis point profit. Well, you're at 375. Well, you just take raw pricing, add 375 basis points to it, and that's the price that you're going to have on the street. Is 375 basis points over wholesale, with what's there. And I think that's where the misnomer comes in, where you're looking at that. Now, sometimes I'll see a company that has, a whole lot more load to that. And I see little branches that have a whole lot less load than that, right? So I'll see a company that might have, their costs are, higher because they have, more legacy costs or something along those lines. Well, if that rate sheet is built on 105 or 105 and a half, that loan officer is going to have less to go to the street with, when you start to see that. And I think that's the misnomer, that's out there. And I think that you just got to look at this and just make sure, there's no such thing as a free lunch, right?
Right.
That's the whole angle behind.
Well, okay. So let's talk about that. So when someone moves companies, right, they get this bonus, right?
Right.
And we don't do that. And I think a lot of companies are getting away from that. But for a while there, you were getting
a couple
huge
years
signing
ago,
bonus. I mean, I've had somebody that was doing maybe like 3 or 4 loans recently. The first question they asked me was, how much money are you going to pay me to come over? I was like, what are you talking about?
Right.
But they're just going off of what they've heard. People are leaving, and they were getting big signing bonuses. But where does that signing bonus come from?
Right.
They're not getting a check, and it's just like out of nowhere,
yeah,
right? Like you said, it has to come from somewhere.
Right.
So where does it come from?
Yeah, well, there's not. I think sometimes when you talk to loan officers, you get them to the point where it's like they're thinking there's another 50 basis points behind the scenes, right? When you've got a transparent organization like yours, I mean, it's right up there in front of it's right there in front of you. You can just be able to see where it is. So there's no extra 50 basis points that's there. So ultimately, when a company says, let's just take $100,000, right, and you get it's a top producer, you're going to write a check for him for $100,000. Well, where do you think that money's going to come from? I've seen it over my years, and I've been doing this almost 35 years now, that I think you could look at this and say, well, maybe it's going to come from retained earnings. Maybe it's going to come from a cash in the bank that you've accrued over time. Most of the time, what's going to happen is you're going to ultimately add that to the rate sheet, and that's like totally transparent, right? It's going to be added to the rate sheet. So that means that you're going to be selling a higher rate. Well, who's really paying for your signing bonus? The consumer. Right.
Or
so in a higher rate.
under you that are in the
branch. Right.
Branch, right?
I mean, again, everything costs something. The only question is who's going to pay for it, right? When you start to realize that. So I think, that's somewhat of the misnomer. And I think it's where I start a loan officer today. If a loan officer comes to me and says, Tom, can you give me some advice? What should I do? And I would start with what rate are you selling on the street, right? If he's selling 4 3/4 on the street at XYZ, then ultimately, you look at this and say, okay, based upon your new arrangement, just want to let you know you might be making 25 basis points more in comp, but you'll be selling a quarter higher in rate. Can you do that? It's like, oh my God, that'd kill me because I think I'm high today. And I think most loan officers today, Ryan, you can probably provide world-class service to a consumer and maybe an eighth, maybe a quarter. But you get to the point where it's a half a point out or things like that. I mean, that's the struggle that you have is all of a sudden you don't be competitive in rates. Now all of a sudden your mind starts playing tricks on you, and you think that there's every rate quote
You
that
start locking below floor.
Yeah,
and next thing you know, you're not profitable.
I call it the circle of death, right? You
Yeah.
lock it below floor.
Yeah.
What happens? The company loses money. What do? They ratchet your rate up again. You can't make that number, right? So what happens then? It goes, again, it comes back, and it's just a circle of death. I mean, it just becomes sooner or later, you've got to ante up and start realizing what it would be. And I think that's the difference, in today's day and age. I think the other part that you start looking at, on the compensation side is that and there's bad actors in every business, and I'm not blaming the mortgage business. There's some great people in the mortgage business, and there's some bad actors in the mortgage business, right? So you think about it, it's like, you've heard the old expression, you can boil a frog and just turn it up 1 degree at a time.
Right.
Well, if you start out with this rate and say, oh my God, that's a great rate that I have, it's the same rate I'm selling today, and lo and behold, the company's a bad actor, which you might not know at that point in time, and they start ratcheting up the basis points by 1 basis point a day, 90 days down the road, your rate isn't as good as it used to be. Next thing you know, your rate's up a quarter.
Right.
And all of a sudden, now you can't sell, and now you're stuck because you don't want to move again because your realtors are going to follow you, and they think you're just jumping around. And it just really becomes a real issue,
right,
as we've all seen throughout the time. And sometimes people overstay their welcome, right, and they say, this isn't going to work for me.
Right. And then the movement, or move from one correspondent to another correspondent. I mean, at the end of the day, let's talk about the actual pricing, right? If it's us or one of the other correspondents in town, they're getting a loan.
Even a broker, because the wholesalers.
So that number, that original number, say it's 450 basis points, it's pretty similar with almost everybody, correct?
Yeah.
I mean, within a little bit.
I think rather than look at it the 450 basis points, I think you got to look at raw pricing, right? XYZ is buying the rates, buying their money from the same place as ABC
Right.
is. There's no window that's cheaper.
Right.
To go to. That might be a little cheaper because they've got a
might
better
be more
hedging
volume
program.
or
They're doing
something.
more volume. They
Yeah.
got some volume incentives, but it's going to be 10, 20 basis points maybe difference, with what's there. And I think that's what you got to be concerned with, is that you got to look. And I think that most of the time, if a loan officer comes to me and says, try to look for the essence match, right? It's not always about the money, right? If it comes down to, some guy can offer you 100 and 200 basis points. We've seen those companies come and go. They offer you a 200 basis point split. Well, where do you think it's coming from? I mean, just take a step back and try to realize it and say, holy cow.
Right. It's the pricing could be worse, but it also could be that they're not paying for support.
Right.
So all of a sudden now
you got terrible people in the back room.
Right, and you've got
it's a revolving
it goes down
door.
and down and down. Oh, I make 250 basis points. Well, really, you don't.
Right.
You make
Well, if you wanna-
135.
I mean, if
after
you remember
paid
the
for
olden
everything.
days, I mean, you've been in the business long enough. You can remember the company was started out of Colorado called Clarion. They paid almost all the money out. Well, the problem with that was you had a loan officer who was good at sales, who now had to process the loan, and had to take all the paperwork and submit it to underwriting and everything else. That's not highest in business. You know this better than most, that the originator, who's a great salesperson and a relationship builder, he's typically not very good with paperwork.
Right. That's me. That's who you're talking about.
I was me too. When I was originating, they said, Tom, step away from the paperwork. Don't promise the customer you don't need anything. Just have them ask me, because that's where the struggle becomes.
Yeah, you surround yourself with the best people that can do the job. Like loan surgeons is what Stuart always likes to say. It's like we have incredible loan surgeons doing the surgery, right? And you can bring in the business, and if you have to sit down and actually calculate income and go through tax returns and do all the paperwork, and is that your greatest and best use of time, right?
No.
And this is a whole nother thing to talk about. It's like you have people that can't see past giving up basis points to go and join a well-oiled factory, right? So you've got this whole you can go join somebody, maybe pay 20 basis points for them to do the loans for you, and knowing that the process is 5-star and it's going to be amazing. Their clients are going to be so happy. The realtor's going to be happy. But at the end of the day, they're like, well, I'm doing my 5 loans a month, and I'm in my office screaming and yelling and complaining and not happy about my life, and I have no time. But yet they can't go, okay, wait a second, so I have to pay 20 basis points. There's no way I can do that, because mathematically I can't see that.
Right.
It's just too much for me. But yet it frees up so much time for them to actually go get more deals, make more money, be home more.
No doubt.
I mean, it's a vicious circle, and it's so hard for people to wrap their minds around it. And
No
some
doubt.
of my closest friends can't wrap their minds around it.
Yeah, it's just trying to do it on the cheap, right?
Yeah.
It's just it's like figuring out Instead of going to the cleaners, they got these things out now that you can do the cleaners yourself, right? I mean, well, how much do you really want to be sitting there doing cleaning? I think we
No,
use
the best. This is a great analogy.
when you and I
It's
talked
the
about it
lawn,
earlier.
right?
Yeah,
It's like you buy this house and you see this amazing green grass in front, right? And they're using a TIF lawnmower, and it's just beautiful, right? And then they move in and they go, wait a second. Well, I don't want to cut the grass because it's July 4th and it's the hottest day of the year, and I don't want to do it.
yeah. My
And
wife's
I'm
on
not
my
good at it.
case. She's got me
Right.
four times over and over
Right.
again. She said, "When are you going to cut the grass?" It's like
Right.
finally you throw up your hands and you say, "All right, shit, I'll go do it."
Right.
Right. I learned a long time ago that I'm better off figuring out a way to pay for the landscaper and do the thing that I'm
Right.
good at rather than me to do the landscape because I hate it.
Right.
I'm a condo. If it was,
Right, you're a condo guy?
I'd be a condo guy, right?
Right.
But I mean, I don't like the condo
Right.
atmosphere, but I like the fact of having the green grass, like you said. But I'm not doing it.
Right. And then I get the thought process though too, right? They're like, well, my relationships are built because they trust me, and they think my partners, or so to speak, say I do a great job, and so if I don't do the deal, I'm going to lose my relationships and that sort of stuff. So I get that. That's rarely going to happen once you get into a really good, you go through one process, one loan with a really good team. Those people that are your partners, they're going to go, okay, this is awesome. Like, this is a great, well-oiled machine. I trust you, and I know you're here for me 24/7. This is awesome. So
But I think it's
get it.
dividing and conquering. It's like you said
Yeah.
with the surgeon part.
You gotta sell through it.
You don't, the surgery. I mean, if you're going to be a surgeon, you shouldn't be cleaning up the operating room after you do the surgery, right? I mean, that's just not highest misuse of the surgeon, right? Like Stuart says, go on to the next one, go on to the next one. I think I played both sides, right? Because I had a real estate company and I had a mortgage company, right?
Yeah.
If you just tell the real estate agent why. Right. Let me explain to you something. I've got the best person for paperwork. My cousin, one of the things that drive you crazy is that customers ask you. You ask the customer for the same thing 2 or 3 times. Right. It's like, let me step away from it. Whatever she says, get her.
Yeah.
Right. That's what my relationship was. And I tell the real estate agent it's better for the customer at that point. I use the equation. And it's oftentimes I think we miss. Even with the consumer, we miss the fact that says, I think the consumer will give you everything in the first, probably 72 hours. They'd probably give you a blood type. You'd probably give you a blood sample, right, if you asked them. What drives the consumer crazy is as you go down the road with them.
13th day.
Yeah,
the
it's like,
17th day,
right. It's like, and then they ask, didn't you just ask for me on this, right?
Yeah.
So it's just like I did a podcast, probably 10 years ago. And I said, well, the way you got to look at this is it's like going to the dentist, right?
That was AM radio, bro.
Yeah,
There was a
right.
podcast that was- so.
Right. But, it's probably 20 years ago. So it probably was on a, but, bottom line is that you look at it and you think, it's like going to the dentist. I mean, the dentist would say to you, if he was, he's giving you a consultative approach, he'd say, listen, found a cavity. You got 2 choices, with Novocaine or without. Which way do you want it?
Yeah.
And I think the customer would much rather have it with Novocaine, which says, tell me everything you're possibly going to need, and then I'll get it to you. And then don't ask me for anything because I'm packing my stuff away. I got to get the kids started in school, all the other stuff that's with it. So I think sometimes it's on the loan officer. I've always said, from a loan officer compensation standpoint, I had a mortgage company for 19 years. I said, listen, I don't have a problem paying you all the money to do all the work the way I want it done. I think sometimes you run into the issue where the consumer, where you say, well, I called it an application, right? It's like just some writing on a napkin,
Right.
and you pass it on to your processor and say, go ahead and process this. And the struggle with that is that as you look at it, that costs money. When you surround yourself with people, that costs you money, right? So if you have I've seen, guys doing $3 million a month that get 5 assistants. It's like, well, who do you think's paying for that? Well, the company supposedly is, right? But what do you really think?
Right.
It's all costing something. It's coming back to your rate sheet, right? Because I got to surround you with those people, and that's where the struggle becomes. So I think that, do all the work the way we want it done, right? It's like saying, let's get all the documents. How do you know you don't even have a loan, right? When you're looking at this from a loan officer's perspective, do you know have you calculated the income right? Because if you don't know you have a loan, 30 days from now, you have the conversation with them. It says, just want to let you know I can't do your loan because your income's off. Well, so I gave you all my income stuff up front.
Right.
That's the struggle. So I think that's where you look at it in a cost standpoint.
And even like right now, it's like the upfront underwriting is like the new, sexy thing, right? And,
Right.
And pretty much if you were a strong LO, you're doing that.
No doubt.
You've always been doing that,
Right.
right? And now, even if you are working for a company that says you're doing upfront underwriting, you as an LO, you may not be doing it that way because it doesn't matter where you work. I mean, there's your really strong LOs in every company.
Right.
And then there's the good one. There's average.
And everything we
good
do.
and bad, and no matter what. And everybody's. The goal is always to have strong LOs, and that's always been the approach. Obviously, at VIP, to have as many, it's a high level people working there. But you're just going to have different people doing different amount of volume, right?
Yeah.
And it's, you might have a guy that's doing 25 that doesn't work nearly as much as the guy that's doing 3.
Yeah, I came from right after when I had Majestic, probably halfway through. I mean, I screwed it up for 7 years. I had it for 19.
Right.
So the first 7, I didn't know. I didn't have a clue. And ultimately, I was fortunate enough to be in a group called YPO, which is Young Presidents Organization. Yep. And I was in a group that was 12 guys that were mostly in the manufacturing business. And Jimmy John was one. I knew Jimmy when he had 57 stores. He's got 4,000, 5,000 stores, whatever it is. And I learned a long time ago that I'm in the manufacturing business, just happened to be manufacturing mortgages rather than manufacturing sandwiches or pizzas or whatever these guys were doing. And I think that you've got to have some sensitivity. Today, when you look at a loan officer and somebody says, well, Tom, what advice would you give a loan officer today? I said, have some sensitivity to cost. Don't just keep asking the boss, throw people at the problem, right? Because ultimately, when you figure this out, it's really going to cost you, your rate is going to be higher, right? So it's really going to cost you some way, shape, or form. Maybe not today, but eventually the company can't just, or they're going to be out of business and you got to go find another job anyway because they're not making the number. So I think that's important. Know your numbers, I think, is important. I think you start looking at this, big picture wise, and I think that becomes the best employee, right? If you keep asking the boss to throw people, just, I need another assistant, I need another assistant, I need another assistant, you don't realize those things, it's $50,000 every time you turn around, plus benefits, plus FICA matches, and everything else. I think that's the struggle.
Yeah, it's funny. I was looking at like a spreadsheet that was showing everything from like the telephone costs to the, obviously the rent to the water to the, everything that goes on in the actual facility that nobody really gets down and dirty with.
Right.
It's like 100 and plus things, right, that are costing. They're like, well, what are you doing for me from a corporate level? Well, all this is what we're doing.
Right.
And it does cost this amount. And I know with us, like you said, it's an open book, so to speak, and we know exactly how much we need to make from a corporate level on a VA loan or an FHA loan or a conventional loan. So So when an LO comes in and they're like looking at us versus other company, and they want to run their own branch, they know they can mathematically just go, okay, am I going to be able to do this because this is how much we know that corporate needs to make.
Well, I think the other thing that I see in that 491-month study is that the guys who are making the most money are the leaner, smaller branches, right? Because they don't have the legacy costs. And sometimes I see companies that are branches that are built for, $10 million. They got enough people to run a $10 million organization through their monthly, and they're only doing 5. Well, Mary's been with me for 12 years, and I don't know what to do, and she's my sister-in-law, and all the crazy stuff. So eventually you can I'm okay if you make the decision to keep those people. Just understand where it's going to come from. It's going to come from your bottom line, or you're going to have to add it to the rate, which is going to make you not competitive. And I think the one thing that
you just take a lower comp,
right,
or
lower comp,
happening,
right,
which is going to have to happen.
Right.
People are just going to have to start sucking it
no
up,
doubt,
and understanding that.
I'll tell you the one thing that Jay, your boss, Jay Barber, and I, really 6 months ago, he hired me to come in and really do a profitability assessment on the whole organization. And I'll tell you the one thing that he did, which it was remarkable to see him do it, and I saw him do it really quick, was the whole idea behind shared services, right? When you've got, you can't hire a half a processor, right? So if you got a processor and you can't fill her day or his day, right? Now you got to look at that and say that's unused capacity, which is, human resource waste, which costs you money.
Yeah.
With what's there if you know the numbers. But Jade took on that shared services mindset, and he brought the talent inside and then charged a per file fee to the loan officers, which I saw an improvement night and day. Overnight, I saw an improvement in branches that now push the people off to corporate, right, and then charge the per file fee, and then you don't have to worry about it, right?
Yeah, and to touch on that too, it's like not everybody loved that though, away, right?
It was,
and so he has to sell a lot. He has to do a lot of selling on new ideas and things and shakeups and stuff. And I think for a little bit there, people were a little irritated and pissed off, to be honest with you. And as you know, and we did have to let go of some people that had been around like for a long time. That was
everybody
really, really, really hard. And people, and we really didn't let go of that many people.
Right.
Maybe rumors were that we did, but it was really not. It was like 7 or 8 people.
Yeah.
But every company did, right?
Right.
At that point. And you know, I have a lot of friends at other companies at high levels, and we have candid conversations, and they're all said the same thing. Like, hey, listen, it's just what has to happen. Right now, things are all of a sudden, you know, rates are good again, and people are freaking out, and like, you know, everybody's refining. One of my friends like, I have 18 refis in right now.
Yeah.
I'm like, well, okay, you're not okay.
It's like WrestleMania,
right? It's awesome.
Refi-mania 17 or whatever
Right.
this is, right?
People are making some serious dough right
Yeah.
now, and so everybody's happy. But things are gonna flip again, and like
Who
you said,
knows how long it's going to last, right?
Right.
But I think the other thing that happens, Ryan, is that I've seen loan officers take their eye. I've been doing this 35 years, right? So you see loan officers take their eye off the ball. They were down this prospecting road of taking care of realtors and developing new relationships and everything else. And all of a sudden, it's like, hold on, rates have dropped again. So they drop
Right.
all that.
They're going through their database, calling everybody. Hey,
right. So now they got 18 refinances in the business, and forget about that. Well, it's not going to be here forever.
Right.
I used to say from the refinancing side, your own success will cause your own demise. If you get everybody safe at 3.5% in your whole database, and rates don't go below 3.5%, you put yourself out of business, right?
If you're not developing new relationships, that's for dang sure.
Yeah, and if you want to grow it, I think that's the best part of it. If you want to grow your business, you have to think bigger than where you're at today.
Yeah.
You can build one car at a time if you're only going to build one car. But if you're going to build 20,000 a day, you've got to have some assembly line that's with it. And I think that's the difference. You know, where people are at today is that if you're doing 5 loans a month and you want to, at some point in time, want to get to 15 or 20, you've got to start thinking of it as a manufacturing business, right? Mm-hmm. And highest and best use of you might be to go out and talk to real estate agents and develop relationships and let somebody else handle the paperwork. You know, some of the best people I've ever had in the business, it was always hard to get them to leave that alone, right? Nobody could do it better than they could. Mm-hmm. But ultimately, I think it's just something you got to be able to pay attention to.
I mean, it's really hard to do all of it.
No doubt.
To go get the relationships, get the loan, come home, come back to your office, do everything there is to do with the loan, and continually build relationships and have those coffees or dinners or happy hours or just workshop. You can't do it all, right? And so then you hire people, and then and eventually you're just sitting in the office and you are structuring deals and you're getting away from the sales side of things. But a lot of people love that part, which is just it's another angle, right? You hire a business development. It doesn't always work. This is the thing that you
got to figure out what your niche is. What are you good at, right? I mean, if you're not good at being a landscaper, I mean, my wife goes out and gardens still today. It's like I would not. You got to be crazy. What are you doing? Right. And people get off on it, and it's just you got to realize what your niche is. What are your strengths?
Right.
And I think that's where you got to really start. But it's a hard decision to make when you say, hey, listen, I'm not really good at the paperwork side. We can surround you with good paperwork people. Right. And then ultimately, but you're going to have to pay for it because everything costs something.
Everything costs something. I mean, and the first time you and I actually spoke, it was really about all the movement was happening and people were coming over for the money side of things, better rates or looking at other places, right? And for me, it's never been that with us, right? Most of the people who have come over to our company it's been through relationships. The same reason why we get business through realtors or whatever, financial planners or whoever comes to us for a loan. And so I still feel that way. And no matter where you're at, really, like, don't leave your company because of the money or because you think you're going to get a better rate somewhere else, because the money comes from somewhere always, like you said, and somebody's paying for it somewhere. It's about, like, the cliche term, I guess, culture. I don't know. For us, for me, I mean, I have my days where I'm not all super stoked on everything that's happening, but all my friends work there, right? My family works there. Like, I love where we're at. We're at VIP, and I have tons of friends at other companies that are awesome companies and great people. I just feel like from just a universal statement, nothing to do with VIP. Like, if you think that, like, your life's going to change so much because you're going to leave in one company and go to the other company, you're going to make so much more money because your rate's going to be so much better, it's not going to.
Well, better yet, look at it this way. If the company you're going to go to is going to give you, let's just say they give you 50 basis points more in comp.
Yeah.
Right? But there's no better rate, right? That's out there. So what they do is they raise your rates by 50 basis points, right? if you're comfortable with where you're at, tell you want a higher comp plan and raise my rates, and you can stay in the same place and make the same amount of money.
Right.
Right? I mean, when you start to look at it. So, I mean, it just doesn't – I think you nailed it on the culture side, because I think you got to have trust, right? And what you see is what you get, right? So it's just tell me like it is.
Right.
I'm okay with it, right? If you need – I've got to make that decision. If you need X number of dollars to be able to perform, I've got to accept that. And don't bitch about it, right? I mean, it's just you're here. This is how much we're going to need to charge. I mean, I had an open book policy at Majestic Mortgage, right? So I showed almost all down to the bottom line. I had a great profit sharing program. I passed out $365,000 in checks one year. I mean, to 51 people. Jeez. So it was cool. It was just a top 5 moment of my life, and it was my policy was I didn't want them to spend the money stupidly, right? Yeah. Pay down their Visa or put it in the bank or something like that. I wanted them to have something. Some widget that they could have. So, I mean, I had stories of people buying a Harley and, all kinds of other stuff that were pretty high up in the organization, or a snowmobile or whatever it was, being from Chicago.
Right.
I mean, that was what was there. So I think it's a matter of you nailed it on the culture side. You got to find the fit. If it's not a fit, you know it. I think you kind of kid yourself over time if you're in the wrong place. After you get there, it's like, nah, this is not going to work for me.
Yeah, and not everything's going to be perfect.
Yeah.
And no place is perfect.
Right.
Right. You're going to have grumpy people no matter where you're at. So for us, I feel like it's just a good scenario, and I know people come to our company mostly because of that.
Yeah,
right? Because a lot of our friends are there, and we've built this company was built on friends and family, and
you got a lot of tenure there.
And a lot of tenure there, and not a lot of people leave.
Yeah,
and so for me, that's mainly the reason why we're doing this today. Obviously. And again, Tom does not work for VIP Mortgage.
No,
he's a consultant.
Not that I haven't been asked.
Yeah, but he's pointed out a lot of things that a lot of people didn't know, and a lot of sharp people in our company have learned a lot.
Well, I think that's a big.
Better at
we talked about it. Prepping for this. I think sometimes ego gets in the way, right? Where people just want they've been doing it this way for so long. And they're afraid to let me look under the hood with them, right? And all of a sudden I'm going to expose something that's negative. And to Jay's credit, it's like, Tom, tell us how to fix it, right?
Yeah.
And that's a hard thing for most people to be able to realize. And I don't think same thing with loan officers, right? It's just like it's a real hard thing to do, to be able to put yourself in somebody else's hands and say, hey, what do you think I should do? It's like, well, tell me a little bit about yourself, right? What are you good at? And I think you've got to be able to have the right environment, because I've seen people thrive in the right environments over years. Right? If you got the right person in the right environment, I mean, they go from 3 loans a month to 10 loans a month, just like that. So, and it's not for everybody. I mean, there's companies for, there's companies for the people that want to do it one way, and there's companies that want to they don't want to spend 7 basis points to get their loan processed or whatever it is that would cost them. God bless you. Do it yourself if that's what you want to be able to do. If you want to have more time off and lower your handicap, God bless America. If you want to build your business, it's a whole different ballgame.
I mean, if you're spending that much time at work, you got to be at a place where you like the people you're working with.
Can't be miserable.
Right. And you start to see some companies imploding, and that were top companies when I got in the business. And it's kind of, every time you ask the reason why, it's the people, really. Right. Like if it's a max exodus, it's the people, right? It came from somewhere up top that's like, this sucks, I don't want to be here, I don't like the people.
Yeah, or you're lied to.
Yeah, or you lied to.
Right. I mean, that's just where it comes down. Trust is a big thing. So I think that, overall, I think if we circle back, I think always realize everything costs something. The only question is who's going to pay for it, right?
Right.
And then you look at it and say, the loan officers, you just got to be able to, try to find what your sweet spot is. No different than, what position you should be playing through that process. And I think from a company standpoint, you both need to know your numbers. If you know your numbers and then you can make in-flight corrections, I think that becomes a big deal.
Yeah. Cool, man. Well, I appreciate you being on.
Well, thanks for having me.
Yeah, man. I think
awesome.
It's great. And I hope that we can get LOs out there to watch this and really spend 30 minutes and really understand it. And then obviously they can call you and hire you and go through stuff, because it's at the end of the day, everybody needs to know, especially from a P&L standpoint. And if you're at another bank right now and you're not quite sure, it's great to have someone, a third-party person come in and go, hey, wait a second, maybe I'm not making the money that I thought I was, like we discussed today, right?
Well, I think the third-party part, that's why I couldn't. I mean, I love Jay to death, but I couldn't be an employee there because I can't keep a neutral position, right?
Right.
if I'm an employee there, I might be swayed one way or the other, right? I can take a neutral position. And I think the best thing for me, most of my stuff will be posted on LinkedIn. So if you're listening to this and just connect with me on LinkedIn, you'll see all of my posts will come through LinkedIn. Or if you want to send me a direct email, just send it to tom@profitabilitycoach.com. And I'll be more than happy to help you. This is my turn to give back, on that side, because, people did it for me in the beginning of time. I wouldn't be here without probably a laundry list of people that if I mentioned a few, I'd probably screw it up.
Yeah, don't do
They'd
that.
all be mad.
I know who you're talking about, though.
Yeah.
All right. Anyways, thanks a lot.
Thank you.
And everybody out there, this will be posted on Facebook and hopefully wherever Rensler puts it for us. And so this was Getting Real with Ryan.
Yeah, that's
All
right.
Cool.
Getting
Thanks,
Real with
everybody.
Ryan. Thanks.